Okay, so welcome back, and Avi's just taken you through the setup where he's described the different indicators. There are 5 indicators that he uses in order to get in, and only 1 indicator to get out. So they all have to really line up. Well, I don't want to explain it because he's going to explain it to you in just a moment, but what I did want to emphasize is that it's a 1-hour strategy. Remember, in the bottom right there, you can actually see that each bar that you're looking at is 1 hour. So the great thing about the strategy is that you don't actually need to look at any chart at all before or after the hour. You just look at it at the hour. So maybe 1 or 2 minutes before, you make a decision to either get in or get out, or whatever it is that we do based on the rules, but then you don't need to look at it again at all for another hour, which is brilliant, because for people who are really busy, people who are on the go, for people who have a job, they can still use this strategy. Now, if you're actually day trading, you can actually improve on this strategy and do other things, but for now it's an hourly strategy. Each one of those bars is an hour, and even if the indicators move during the hour, you don't worry about that, because the situation could drastically change if you're looking at it from 1/4 past to 1/2 past to 1/4 to. But on the hour it then sets, and that's what we're really looking at. So 1 minute 2 is fine, and then on the hour, so you've got about a 2-minute window to see what to do. And I'm going to hand you back to Avi, who's going to explain exactly what each of the indicators means and does, and what needs to be, the best setup in order to make money. Over to you, Avi.
Hi guys, thanks Marcus. I'm going to take you through all the indicators now and really just explain what we're looking for from the indicators, and also when really the perfect setup is there and how to actually get into a trade and so on. Right, so if you look at the top here, you get a little key to see what indicators are what represented by which lines on the graph. So the 2 grey lines, grey purple I guess, on the top and the bottom are the Bollinger Bands, and together with the standard deviation, they're the first things we look at when we look at the market. From the Bollinger Bands, we're looking for them to pinch. So by a pinch, we really want them to converge to go towards each other. So if you're following my cursor here, from this point to really where they pinched, almost to, if you think about it as a sausage, it's the completed sausage, and at this point is when you can be considering that they have pinched. So after that, we're looking towards the standard deviation to really correlate to us whether this is a good pinch or not. The reason we do this is purely because the Bollinger Bands don't have an independent scale, and on the right hand side is the price scale. So if the market does decide to move a lot during a week period, so from the standard deviation, we need to assess a range over the past few days to really see if the Bollingers, the pinch we're seeing at the moment, is good enough, or whether we can wait for a better pinch to occur. The way we do this is by zooming out slightly, and really a pinch is assessed, a good pinch is assessed when a breakout occurs after this. So if you follow the cursor once again, a pinch occurred here, and a breakout, whether up or down, occurred after this, and the market moved a fair bit. It doesn't have to move as much of this, but on this occasion it did. So if we're looking back to this day here, there was a pinch around this period here, and then the market broke down once again. So what we're doing is we're going towards these pinches on the Bollingers, and if you leave your cursor on there, you get a whole load of data coming up. You need to look right at the bottom where standard deviation is, so on this bar here, and if you read off the value of 28, what you need to do is either make a quick jot of that down, or just keep it in your head. You're going to go move to the next pinch and write the next value down, which happens to be 28 again, and another pinch was around this area here, and the standard deviation was slightly higher of 29. So now you got 3 values down, and you're just putting these down and forming a certain type of range. So at the moment your range is 28 to 29, which is really tight. On certain days it may be slightly larger. So really what we're waiting for now is, when we're assessing if we have a good pinch or not, we may be in 2 minds in actually assessing this. So we're then looking at the standard deviation to see which value is going to give us on this given day. So definitely at the moment, if you're assessing if the market is ready for us to trade, the standard deviation of 75 at this current moment is way too high, and so we'll be waiting for the standard deviation to drop to at least 29 till we would be comfortable in assessing that the market is ready for us to trade. By ready for us to trade really is when the market is less volatile, and it's also coming to a time where the market is ready to almost break out. So there's going to be an increase in volatility, and hopefully assessing all the indicators correctly, when going long or short, you have a 50% chance of making money or losing money. Using the indicators correctly will increase the probabilities of you making money. So moving on from the Bollinger Bands, once you assess that the market is ready for us to trade, we're then looking at the MACD, then the momentum, and then the volatility. So from the MACD, we're looking for either a buy or sell signal. The MACD is what gives us that and nothing else. So from the MACD, we're looking at 4 different signals from the MACD, and I will be taking you through them in just a second. From the MACD, we are then looking at momentum. Momentum is just really the momentum of the market, and we want that to be complementing what the MACD is telling us to do. So we're just going to be looking over the past 1-2 hours and seeing where the general direction has been going down, like it is where my cursor is at the moment, or has been going up, as you can see in the last few hours of trading here. From the volatility, we want the volatility in the market to be as low as possible, so that we're giving the market a chance to increase its volatility, and hopefully the increase in volatility will help the market go in our direction. So if you're looking at the current volatility, it is very low, and really our criteria is whether the volatility is too high in the market. To assess this, we're looking at the current volatility and seeing whether it is below previous peaks along the volatility indicator here. So if the easiest way of assessing this is just holding a cursor over it, you get a red horizontal line coming across the volatility indicator, and if this is lower or much lower than previous peaks, then it is good enough for you to trade. So by peaks, I'm talking about these peaks here, this one here, this one here, and this one here, and also here. So I hope everyone would agree that this current moment of time, the volatility is much lower.
Okay, so it's Marcus here. So just summarizing what Avi said, the first thing we look at is we look at a squeeze in the Bollinger Band, such as here. So this is the top of the Bollinger Band here, and this is the bottom of the Bollinger Band. As you can see, they're squeezing together right now. You can't always see that they're squeezing, because it depends on the view, and it depends on the price movement. So the Bollinger Bands are very much together with the standard deviation. So we're always looking at the Bollinger Bands and the standard deviation together, and we're looking for the standard deviation to be just about as low as any lows that have been over the last 3 days or so. So that's the first thing. The second thing is the MACD. The MACD tells us the direction in which the market is going, and it's either down or up, and if it's down we'll sell short, if it's up we will buy. But that's only if the Bollinger Bands are pinching and the standard deviation is low. If the standard deviation isn't low, we wouldn't even look at the MACD because we're not interested. Okay. The third thing is the momentum, and the momentum needs to be going in the same direction as the MACD signal is telling us. So if the MACD signal up here is saying down, then the momentum also needs to be going down. If it's not, then we can't go in. If the MACD, so for example, like here, is going up, then only if the momentum is going up are we interested in. All the ducks need to be lined up. Finally, volatility. As you can see, there's this quite high volatility here, and here, and here, and also here. And we really want the volatility to be fairly low, and as we get into the trade, either going up, buying, or selling short, what we want is the volatility to increase as we're in the trade, but not before we're in the trade. So we definitely want to make sure that the volatility is way, way, way below any of those peaks here. And as you can see right now, for example, today it's nice and low, and that would be good for us to get in. Okay, so that's the end of this section. So we're going to go on to the next section just to drill down a little bit more, and Abby's going to tell us the specific rules about what, you know, the setup, whether the market is ready, and then afterwards when to get in.